Good evening. Welcome to Admiral Markets webinar. Thanks for joining us on this 12th of May. Nenad and myself, we're going to take a look at the fundamental outlook for the 2016 year, and we're going to take a look at the fundamental analysis. Of course, often we dive into technicals, but this time around we wanted to look at the long-term focus. What kind of developments could we expect from this perspective in this year? Before we dive into today's topic, be aware that this is shown to a global audience, may not be suitable for everyone. Take a look at admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity for more details. Also, please be aware that trading for exchange and global financial markets is considered high risk and may not be suitable for everyone. Please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer and you are aware of the risk involved when trading. All right, thank you so much for that attention. As you're probably aware, during April and May, there's a special bonus opportunity for new and existing traders, up to 50% deposit bonus potential there, but do take a look at the terms and conditions to make sure that it is suitable for you and something that matches your interests. So take a look at that after the webinar. And today's focus, we're going to talk about monetary policies. We're going to talk about what kind of key developments could be happening in 2016 and some stats that could be good to keep an eye on. So we're going to talk about all these things in today's webinar. We're going to do it a bit differently. Normally we split the webinar kind of in two pieces, but we don't want to, Nenad and I do not want to rehash, repeat things that the one already has said. So we're going to mix it a bit together. So let me already maybe introduce Nenad here, see how he's doing tonight and how his trading has been throughout today. We saw some pound dollar upside, for instance. Let's see.
Hi, Chris.
There he is.
Hi, Chris. Yes, I'm here. And guys, we will make this webinar a bit interactive. So we'll be talking, Chris will be talking, and I will jump in and so on. We'll comment on various different fundamental things today. And thanks for asking, Chris. Well, trading was pretty much good. As we know, pound dollar was really bound to go to the upside, and it hit our target 45.20. Also, euro yen hit our target like 124.60. So basically, trading was very, very good, and well, we got basically a backwind from BOE today because BOE was a bit hawkish, and actually it made 44.80 to break and hit 45.20 after the announcement. So basically, yeah, it was good. And thanks for asking.
Yeah, so we're going to talk about, first of all, the U.S. interest rate, we thought, because so much is dependent on this, of course, development. It's a very important factor, and we'll show you why as well in the upcoming slides. But first of all, let's talk a bit about what happened last year, just to get a bit of a trend. Of course, the interest rate was going up. In fact, as you can see in this slide right here, the interest rate went up this year from 0.25 to 0.5. Well, you don't see it here actually, but it was flat, of course, for years and years and years. If you look at the USD, look at this, it stayed on 0.25 for 7 years. So obviously the trend was flat. The euro has been going down later. It happened actually in 2011, where it started to make a bigger decrease. It had one in 2008 too, as you can see. So a bit of a delay maybe from the euro. So you can see that the euro went all the way down to 0 from 1.5 a few years ago, and the dollar actually stayed flat and had recently been raised a rate hike, right? So there was a bit of a monetary divergence that we saw between Europe and the US, and that's something that happens often, right? This is definitely not uncommon. Typically, the US leads, and the rest of the world follows a bit later. So the US made the decision to increase its rate hike, and the expectation was that the rates would go higher 3 to 4 rate hikes were expected roughly on average throughout this year. Now, just to give you a bit of perspective, 3 to 4 rate hikes is not that much when you have a rebound in the economy. Sometimes, those rate hikes really go higher a lot more aggressively. So even 3 to 4 is a mild, raise of the rates throughout a year. But so far, we're already in mid-May here, and we haven't seen any rate hike, right? And in March, the Fed warned, look, there is not much evidence. It's not going as quick as we would like to see. The economy is not speeding up as fast as we assumed, right? The data is maybe not looking as good as we hoped for. So for the moment, we're not basically going to raise it that quickly, but there could be a rate hike later on. So it's not to say that there's no rate hike on the table at all, but 3 to 4 is difficult to imagine. If so, maybe 1 or 2, or maybe nothing, right? So it's a different perspective here than when we were looking at the webinar at the end of 2015. Okay, so it's a bit of a different environment. And if you look at the stats here, there's a 65% chance that there will be a rate hike by December 2016. But we're talking about one rate hike. So it's a different kind of story. It's a different kind of vibe. It's a different kind of situation going on than let's say half a year ago. All right. So we're going to have to keep an eye, of course, on data to see how this evolves. If you look at this, the evolution of the Atlanta Fed GDP, this is used to get a bit of feeling of how the GDP is doing. And you can see that the green line here, the forecast, is below the expectation. So there's a bit of bearish kind of pressure at this moment when looking at this Atlanta Fed. And this is a pretty accurate measurement, I've been told, of GDP. So that could explain why, or partly explain why the Fed is careful, right? And why it's not wanted to increase those rates too soon. And it's in a way logical, because if it starts to aggressively or semi-aggressively increase those rates too soon, then it's going to put itself into danger. The position of the Fed might be that it has to reverse its policy very soon after that. If you look at the world data, obviously there's a lot of headwinds coming up. Europe is not doing great. China has its struggles. The commodity countries are struggling. So the U.S. would be really an exception almost in this environment to increase its rates. And typically it does lead the global economy. But in this case, every situation is different. In this case, it might lead that prematurely. So they are, I think, in my humble opinion, I can see and understand why they're cautious. And looking at these kind of graphs, you could support that. All right. So if you look at other, sorry, go ahead.
I also want to add, maybe our traders and attendees don't know, but the thing is, U.S. can have a good impact and benefits from higher interest rates. So I guess that people don't know, but first of all, let me tell that if U.S. hike the rate, it will definitely give higher returns for savers, because for savers, low interest rates usually bring the financial equivalent of a long drought. So they will see some improvement. Even if it's a modest improvement, it will be an improvement. So definitely it will be higher returns for savers. Also, inflation will be, basically the central bank's target for inflation is 2%. But they're definitely, they've been falling short of that mark. So if the Fed achieves the goals in guiding the economy, I think that inflation should remain under control. So a good scenario, a positive inflation scenario after a rate hike might include lower prices, let's say, of important consumer goods. So the inflation could be tamed by introducing higher interest rate. Also, there will be probably more lending, okay, because banks will have a greater incentive to loan out reserves at higher interest rates. So more lending and more interest income for retirees. Because as a rate hike, it brings better returns to savings. So definitely higher interest rates on CDS and other financial instruments will help elder Americans that are trying to live on their retirement savings. And that is a good thing. I'm not sure that people know it, but it can be definitely about more interest incomes for retirees. And one more thing, I think that stronger dollar will help people from US traveling other countries, okay? Because they will need eventually to exchange their own currency into a local currency, and stronger dollar will you will probably you will have to sell your dollars in order to buy foreign currency, but you will get more foreign currency for that dollar. So definitely Fed tightening is definitely a higher dollar, so people traveling to Europe will probably do well, of course, if they come from US. So those are benefits of higher interest rates.
Yeah, absolutely. And the impact of all of it is on the currency indeed, getting more demand for the dollar. So the dollar could be then expected to increase. So the euro dollar would then go down. But let's see, of course, how much and how far it can go. How far can that rate hike go? But it would certainly have an impact on the euro dollar. And if we look at the Citigroup Economic Surprise Index, just to gauge about whether a rate hike could be coming, then we can see at this moment we have a bit of a triple top. If we apply basically technicals to this chart, you can see 1, 2, 3 hits right there at the zero line. So what this economic surprise index says is basically, do the economic data outperform what the market expected? And if so, it's going to be above zero. So if the performance is better than what they expected, right, we're going to see more data points above the zero. If the data is lower than expectations, we're going to see data below the zero line. So if the market, if the data kind of disappoints, we were in this red zone, right? If the data is better, we're in the green zone. At the moment, obviously, you can see that since the beginning of 2015, we've been under the zero line, and recently we made actually a triple top, and we're turning back down. So could there be a couple of months of downside pressure when looking at this, just from a technical point of view? Yes. All right. And could we then maybe bump into support down the road and make a turn again back to zero? I would say so from a technical point of view. So maybe just speculating from technicals on this economic surprise index, right? Just to put it in context, maybe not in a couple of months, but maybe we'll get the rate hike, in the second half, maybe even the last quarter of this year. We have some, from that point of view, maybe some patience still needed before we could get that rate hike from 0.5 to 0.75. And of course, we're talking about very marginal differences. I mean, if you look at the historical context, we're talking about 0.25%. 0.75 is still very low compared to where the rate hike was in the past. Let's take a look at that. Actually, you can see back in 2008 at 4. No, that was the euro, 4.25. The dollar was at 5.25. Even 5% was low if you go back to further, right? But 0.75 obviously even very low compared to 5.25. So we're talking about very marginal differences here. And just to give you a context that 0.75 is really nothing spectacular. But compared to a Swiss bank that is negative rates of 0.75, quantitative easing in Japan and the Eurozone, then relatively that is tight, on the tighter side than the other economic blocks that we usually look at. So it's all relative. Now, you might wonder, well, Chris, and then what kind of impact does these interest rates have? Why is it so important to look at the U.S. interest rates? So just as a refresher this is Dutch, by the way. This was made for a Dutch article. So this verschil is difference, by the way, the difference between the euro and the dollar at that time. If it's orange, the dollar had a higher interest rate. If it's green, the euro had the highest interest rate. So you can see euro was higher here. Dollar was higher here, then the euro was higher, and now the dollar is higher again. And what kind of impact did that have on price? Well, definitely very clear, right? The euro rallied, and basically the dollar has been rallying more or less, specifically here, of course. And this was a great time of choppiness because the dollar implemented the quantitative easing, then the euro did a bit of that, then there's all kind of these differences. Then then U.S. stopped with quantitative easing, so you had a lot of choppiness, and it's definitely connected to major fundamentals as well. So other things besides the dollar.
I would also,
sorry.
Chris, I would also like to add, based on on that slide, basically as we could see in 2016. ECB President Draghi, he told us basically that he would be moving away from interest rate cuts towards some unconventional measures. So what I think is that really ECB, they don't count on a weaker euro to raise inflation because they're probably feared from a reaction of the Federal Reserve. So that is the reason probably why we don't see a significant depreciation of the euro versus dollar. So basically it seems to me, I'm not ECB, but just from the logic perspective, it seems to me that ECB no longer counts on a weaker euro to raise inflation. So definitely that will be interesting to see what those unconventional measures are and how euro will perform versus dollar. But as it seems, at least on technical perspective, we have a range-bound market, but that range is a bit, I need to say, bullish, because euro dips are being bought. We are really far from parity. As I told you, I didn't really expect the parity, so I'm still concerned that we won't see parity anytime soon. And definitely, now this is maybe mid to long term, but euro has the potential to go to 1.7 to 1.2. So we will see that. But technicals, if you open monthly or weekly chart here, definitely you can place a trend line there. You see that there is a clear trend line there. So I think even weekly has a trend line. So basically this looks like, definitely an upward ascending channel. So pay attention to this. This is long term, but definitely it's trying to aim again at 1675. And if it breaks, it will be probably away towards 1.2. So those are the reasons. You see, guys, euro now is not depreciating versus dollar, and it could be that. It could be that because they don't count on weaker euro to raise inflation. They are feared of Federal Reserve reaction.
I agree with Nenad that I think if the euro dollar, I'm still expecting the euro dollar to make a lower low, but it doesn't have to be very soon. It could be at the end of this year potentially. But I think that would be driven by indeed the dollar raising its rate. So when it does that, we might see a turn and a lower low or a challenge of this low, and maybe parity. I can see, Nenet's opinion of why it might not get there because of the euro side. So, but let's see what the dollar does and the Fed does with the interest rate, if it raises and how much, and that could be maybe a factor that does it. Now, from my perspective, it's an interesting squeeze because you got strong resistance at the 38.2 fib at 117, and it had a good pin bar last week on the weekly chart. So I think that a bit of retracement as we're seeing here could happen But we are in this in channel, as Nenad said, so it could definitely be back at 112.50, 113-ish. It could be, again, a bouncing spot and potential move up to the 38 or the 50 fib, right, at 121. Those are all important. From that perspective, if price breaks this channel, of course, after such a pin bar, well, who knows? Maybe we could see a bit of a stronger push down. But as long as we're in the channel, it is in an uptrend channel indeed. So I think that when you look at the monthly, right, we see how many months of this is the 12th month, 13th month. So from a time factor perspective, 13 and further, this consolidation could be finished. So this is kind of the minimum consolidation I was expecting roughly at September last year. Now I think it's about how long can this consolidation last. If it goes beyond the 50 fib, then the bearish scenario from my perspective is out of the window. So those are the key levels. I think that we've had a consolidation that's big enough to be completed. Let's see if it is completed or not, and it can continue down. But if it does break above the 50, then the bearish scenario is out of the window from my perspective.
Yeah, definitely it looks like W pattern on weekly, but as you know, technical suggests that we need to break this point. Point 2 is exactly at 1.6096. So basically we need to break this point in order to proceed towards 2080. But this can also be an Adam and Adam. There is a variant of W, and Adam and Adam needs double bottom, but this is not a double bottom. This is indeed a higher low compared to this W. So this W has a higher low. So it is a bit nasty because on weekly we can also see a bullish hammer. Now we see a bearish pin. So as you know, we don't trade double. I don't trade. We never ever trade double pins. But just for analysis, this is long term, of course. This is not intraday or intra-week or intra-month. This is long term or mid to long term. We could see even a drop, but at this point, it looks like dips are being bought.
Yeah, definitely. From an analyst wave perspective, just to finalize it, this is potential this is a potential 1, 2, this is a strong wave 3. This could be a wave 4. Wave 4s have 3 waves, so this could be an ABC. And then we go down for 5. So from that perspective, I'm still bearish, unless price really breaks above the 50, because then it's not a wave 4 probably. And this is probably some kind of corrective wave that has ended indeed and is over. So, but if it does break the 38.35, there is some space up to that. I agree, right there and here. Those are some bullish spaces. All right, from a wave perspective at least. So some other things that we can take a look at that might impact the markets. Of course, the forex market. One of the things here is coming up next month is the United Kingdom is going to vote on its membership in the EU, the European Union, June 23rd. So that's going to be for political, people that are interested in political process. Or in general, actually, I would say this is going to be very interesting to see how the vote pans out. The value of a referendum, of course. I mean, it's great that people can make that choice. It's in a way, my personal opinion, quite a hefty decision just to make in a one-time vote. I think that if you make such a long-term decision only on one measuring point, it seems to me maybe not reflective of even what people could change their opinion, right? What we think now could be different 2 years from now. So that's just my personal opinion. It seems like it could be better to have a couple of 2 or 3 referendums, so you have more of an average. But maybe I'm getting into too many details. But it seems like there's a lot of things riding on just like one moment in time, which really seals the fate of the UK versus the EU for perhaps forever, right? So there's a lot riding, I would say, on that referendum. and 50.1% is technically enough to make that decision. 50.1 is statistically a tie. So, there's a lot of things weighing in the scale. If it's 50.1 for yes to stay, if it's 50.1 to leave, such a small difference can actually lead to a massive decision. So that something to think about, I guess. So let's see what the outcome is. There are some, of course, advantages for the UK for staying. Everything is organized as it is already in the EU. They have trade partners in the European Union. They can decide about things. They have influence on the EU. The EU is a big bloc, so they're talking with the US. There's big influence they could have through the EU. Some disadvantages. Well, the Brits are maybe complaining about the bureaucracy of the EU. The regulations and etc. So they think maybe they could be more free and have more influence on their own policies if they're not in the EU. Those are just a couple. I'm sure there's a long list of things that can be talked and discussed. From the EU perspective, probably better if the UK stays in. Let's face it, it's an important ally. It's an important country. Could the EU continue without the UK? I think yes. It's I think a bit different. It's my personal humble opinion. If Germany or France would leave, I think that would be almost impossible or very difficult to continue. It's a bit different with the UK, just from a geographical point of view. It's an island. It wasn't a founding member. Is it a heavy hit? Certainly. It would be, could set aside, it could start a chain effect of other countries leaving. So it would be a heavy, heavy, heavy blow for the EU. Could it still possibly recover and manage to continue? Yes. So slight difference, heavy, heavy, heavy hit, but maybe not entirely impossible, but definitely for the EU, better, I would say, if the UK stays. Now, for the UK, I think it's better if they stay in the EU, but this is just my bias and my opinion. But the Brits are going to decide. They're the ones who are, making this referendum, and they're the ones going to making that call. So it's going to have a big impact on geopolitics because if the UK decides to leave, they're on their own. Let's say, of course, they have an ally in the EU, but they're on their own. They're going to seek new relations, and going to try to find their new path as that. So. From a market perspective, a lot of volatility, I would say. And if the Britain leaves, I would say downside on the pound just from a reaction point of view. What do you think, Nenad?
Yes, I agree with you. I'm a bit into this problem, and well, if I would agree with you on almost every point, and I would say that if I were to vote, I would also vote for staying in European Union because, we all know that UK is the financial hub. Now, there are, of course, some implications of is it better to be outside of EU or is it better to be inside? Of course, there are also pros and cons. It's not that ideal. The first thing is that UK could probably save about 10 billion per year on its contributions to the European Union's budget. So they, as with every other country, they have their own contributions. Those contributions are like 10 billion per year. So that will be saved, probably and obviously. Now, this figure could even be higher if either the British rebate was to be threatened in the years ahead of Brexit was to result in overall faster economic growth. Now, where would be the problem, in my opinion? I think that will be property market, because British property market will probably lose if United Kingdom opts to leave European Union. I'm not sure how the implications would be in literal sense, but probably a lot of immigrants who already who already work and stay in UK, maybe they will sell their own properties. Maybe there wouldn't be so strong demand for properties market, and I'm not sure how their status will be if UK exits from European Union. So we don't know the status of immigrants. What will be the regulation? What will be policy making on trade and regulation? So we don't know it. So probably property market would suffer a bit. What I'm not concerned is foreign investment, because it's over exaggerated, definitely, because the access to single market is not the only reason why firms invest in Britain, because Britain is also, and it's always been, financial hub of Europe. So at the first moment, probably we will see a period of weak foreign direct investment, because they definitely need to renegotiate a new relationship. Now, if Britain is able to obtain a new favorable terms, then I think that foreign direct investment will be huge, and they will recuperate definitely, and there will be a lot of new investments. So the first initial reaction to pound will be probably to sell it heavily, but I expect them to stabilize and to buy it heavily. So I'm not, in technical perspective, I think we could see a buy into a huge dip. So that is what I think. So also, I'm not sure that UK will lose the status of financial hub, because they will, as I say, they will try to renegotiate the terms with European Union, and they will be renegotiating. So they will still be connected to European Union, but in other sense than they are connected to European Union at this present. So we will see. What I think is the biggest problem is immigration, because the annual net migration from Europe was doubled since 2012, and that's a huge problem, not just for UK, for the whole European Union. And if United Kingdom gains any power to restrict immigration from Europe, it will depend on that renegotiation with European Union itself. So my opinion is, if Britain wants to retain the full access to market, they need to keep the free movement of labor between the United Kingdom and the Union, because the basic definition of European Union is free movement of labor and of money. So I'm not sure that they will do that, because their main problem is that immigration. Okay, so we will see what will happen. There will be huge impacts at the start, but if UK voters decide that UK should be left in European Union, should stay in the European Union, then still they might renegotiate some terms.
Yes.
So I think that their policy will shift to be specifically designed for Britain's migration requirements.
Ultimately, I think that this is a geopolitical decision for the Brits, and of course, leaving or staying will have impact on their financial situation, investments, and their currencies and their budgets. But ultimately, the reasons I think for staying it's certainly a geopolitical choice. Some others will use other arguments, some other factors to make that choice. From my perspective, it's a geopolitical choice. Will they want to seek their partners by themselves, or do they want to do that through the framework of the EU? Because the irritations some people might have, and I can see that with the EU, are basically, of course, things that could be solved through negotiations, through internal negotiations, through diplomacy, to change that from within. If the Brits give up on that and don't seek that change within and rather exit, I think that's a geopolitical choice. That's not. I think having annoyances with Brussels should not be the reason why Britain leaves, and they should try to change that within. That's my point. If they leave, that's I think mainly a geopolitical choice. It's a long-term choice to rather be on their own and seek their own alliances. So that's my take. Now, of course, a lot of people will not vote that way. A lot of people will vote using different arguments, using different things in mind, maybe business, maybe immigration, indeed, maybe reforms, Brussels. There could be a lot of arguments that people either vote yes or no. From my perspective, those are less relevant to the centerpiece why how Great Britain would vote. But I'm not voting. That's just how I see it. That's what I would think is the most important in this decision. And I think personally, from a geopolitical point of view, it'd be better for Great Britain to stay in the EU. But that's again just my 2 cents. So let's see. I do agree with Nenad that I think foreign direct investment will stay high. Temporarily might dip, but otherwise I think remains an attractive place for capital to go to. So, other thing that could be, slightly, of course, later this year, obviously in November, U.S. elections. First of all, it has no impact on the monetary policy. That's the Fed. So we're talking about fiscal policy because, partly, of course, the president and the government, the Congress, the Senate, they're deciding the yearly budgets, what debt the country has, what is spent. What the income is from taxes. So that's their duty. So that's why the U.S. elections, of course, has an impact on the fiscal kind of perspective in the next 4 years. And that's important because the bigger the debt, obviously, the more difficult it could be for a country to pay back. Now, the dollar has a special role in that because people have such a high trust in the dollar. So they could perhaps even expand the debt and not lose any credibility. Other countries could have a lot more serious problems with that. The higher the debt, eventually markets could lose faith in the ability of the government to pay back those debts and could get punished with high interest rates. And that could lead to serious problems of debt and repayments, and that could just torpedo the whole budget, and the country could have very little to spend after that. So, recent example, Greece, obviously very difficult in its repayments and a lot of pressure on the country to cut costs, etc. So that's very tough for Greece. So that is something that the U.S. Has a bit of advantage, but of course there's also a boundary there. So when we look at the candidates, Trump probably and probably Clinton, we could see that Trump was mentioning that he would like to balloon recently the debt sheet to stimulate the economy, and that he would not even have problems on defaulting on the dollar. Well, that could be, a serious issue for the financial world, for the investors, because if the position of the dollar is not as stable as it seems, it could make the entire financial markets have a different perspective, right? Because the dollar is kind of the base, the most safest aspect, the most safest instrument there. So if that changes, there could be a impact on the other financial instruments like corporate bonds. It could become riskier, and that could all change. For the moment, though, the position of the dollar, of course, is dominating. It's the number one. It's the most traded. It's the most used. It's the centerpiece of the world, and that probably will stay that way, right? What it doesn't have
like
is
just a thing, Chris.
Yeah. Sorry, just to finish. Sorry.
I would like to add.
Sorry, just to finish.
Sorry, I'm not sure that you can hear me.
I can hear you. Just to quickly finish, it doesn't have impact on the geopolitical position. Basically, the U.S. elections, whether mostly speaking, generally speaking, most candidates will not have an impact on the geopolitical position of the U.S. because the U.S. position in the world is set as a leader of the world at this moment in a geopolitical point of view. So that's not going to change. It's not U.S. elections are not going to change that. The dollar most likely and the monetary policy, but it could have on the fiscal. Sorry, Nenad, that's all. Go ahead.
No. Sorry for interrupting, but I wanted to say that what I think is, as we all know, Trump now is like a totally different leader. He presents himself like he wants to be friends with Putin, and he wants to actually make friends with Russia. So, no, guys, usually the thing that a candidate speaks before the elections are completely different things after the elections. So Trump before the elections, and if he gets to be selected as a president, can be totally different. But definitely that we know that Russia is exporter of oil. We know that price of oil tumbles, and well, the economy falters. Now, the only thing that we definitely need to add is that those sanctions that are implied on Russia are only making things worse. So the thing is, Russia needs a US president with who a deal can be made and those sanctions be removed. Now, we know that Trump has been claiming that he wants to negotiate with Putin and so on, but we don't know. It's definitely unclear what changes in Russian international policy Putin would make that would end sanctions. So those are all different implications. And here at the brink of Cold War, we see some bad things happening, but at least they're not the worst. So we have another giant that is also waking, and that is, well, China, we know. And we don't know what implications will be also to China. So given China's economic slowdown, what China does not need definitely is new rules of trade with United States. So China's problems are well known, but their economy really can turn out to be just a house of cards. So we don't know it. What will be the implications? So those numbers for China's economy are not that good. Downside is only happening to be worse and worse. So definitely we don't know if there will be anything to renegotiate with China. Now, I don't say that it's hard, but I don't see at this present time that either candidate can do something to, let's see, promote new trade deals with Russia, China, and India. In the case of Russia, we see that Putin has shown no interest in changing his policy in order to have those sanctions lifted. In the case of China, well, downtrend can only accelerate if trade relations with America, with US are changed, let's say, to be less beneficial to China's economy. So we don't know it yet, but those are the implications. So, Chris, do you agree with me?
Yeah, I think generally yes. I mean, I think that a Clinton presidency would probably be better for China, I would say, because I think it would just continue with the current arrangements. With Trump, I think there is a bit of a bit of a factor that no one really knows what he's going to do. So there's a big question mark there. I don't think he might even know what he does, but that's my personal opinion. So I think that there could be more volatility with Trump. I think with Clinton there could be more stability in general regarding foreign relations, as you say, too, in general. So with China, I think they could probably appreciate more of a Clinton approach. Now with Russia, it could be maybe different. Maybe Russia would have more chance of who knows, maybe finding more potential to talk to a Trump than a Clinton. I don't know. I'm speculating here, but that's just my 2 cents. In any case, we'll find out end of this year regarding that. So other things coming up. Well, we have Spanish elections in June. That's going to be interesting to see what a big European country that is economically struggling is going to vote. We got the negotiations with Greece that are probably going to see some debt relief. IMF is seeking that as one of their conditions. We have a Swiss referendum, an interesting referendum that where they're going to vote on having a base income at everyone a guaranteed base income. So that's going to be interesting to see if one of the things they vote on some other things I think as well. And of course, just generally speaking, politics, of course, in the Middle East and in Europe and Asia and in South America, we have in Colombia, we have some peace talks going on that could bring peace after 50 years between rebels and the government. Um, and Brazil, of course, is having some troubles. They have the Summer Olympics going on, taking place there, but they have some struggles. You see protests there, so that's going to be in the news probably as well. We see, of course, China struggling. So these kind of developments, how will they play out? There's going to be an impact as well. There could be some potential bumps on the road from these countries in 2016, I would say. So this is some things to keep an eye on. Is there anything else you would like to add, Nenad, to this list that comes to mind? There are.
Well, the only thing is I would like to add is this Swiss referendum. Basically, it's really interesting stuff and interesting thing that is like giving a free money, universal basic income, and that is what I have not heard before. And I know that besides Swiss, also 4 Dutch cities will probably run some trials also. And I think Finnish government is also planning to experiment on that. But basically, Swiss will be the first country that will actually vote on a basic income. And that is like, if I'm correct, I'm not sure, but it's like 2,500 per month.
Yeah.
And for kids, it's like 600 per month.
That's the
that is
suggestion.
actually,
Yeah.
right?
Yeah, but in the referendum they didn't mention actually any number as far as I know, but that is the idea of the
I read it
organizers.
somewhere.
Yeah,
So I'm
indeed.
not sure that the numbers are correct, but
No,
as far as
the
I
numbers are
remember,
correct, but they're
those
not
were the
officially
numbers.
mentioned in the referendum. They're not officially mentioned in the referendum, but that is the idea of the organizer indeed.
Yeah, but anyway, it's a great idea. Anyway, that just explains how far they are really in their economy. That their policy, monetary policy, is simply great. And I have really some friends living in Swiss, and well, they really care for their citizens. That's for sure.
I think is it correct that the Swiss will also have a referendum? I read it somewhere, but I didn't double check if that's true. That the Swiss or maybe another country will have a referendum on its banking that banks have to have for every loan they really have to have the entire sum backed up.
Yeah, I read it also somewhere. I don't know the details, but yeah, you're correct. I think that there will be some referendum for banks, definitely. And I remember I read it like maybe a week or 2 weeks ago.
Okay, yeah, yeah, I read it somewhere. I didn't check if that's really the case, but I guess so. It could be still worth checking. But so that could be also interesting to see if that passes, it would have, of course, huge implications on leverage. And well, the good news is that bubbles would be more difficult. Bad news, of course, is that some leverage in some cases is not necessarily a bad thing. I think, in my opinion, some leverage, but not the leverage that we saw during the 2008 crisis, where I think Lehman Brothers were leveraged 33-1, which is too high, obviously.
And
So,
at least these kind of deals are gaining momentum, and that is a very good thing indeed.
so let's see. We got a question. Dines is asking, what do we think about the yen and the negative interest rate? Will it work out? Well,
No, nope, not sure. I really not sure. I don't think it will work out, definitely. Well, now what I think is if yen if yen continues to gain momentum and strength across markets, I think that the Bank of Japan might intervene But the thing is, I'm still not sure that it will have a huge implication on the market, at least temporary, but also negative. I'm not sure really. At this stage, as I already explained, yen, strong yen is definitely not good for Japanese economy. Not good at all. So they are starting, they really try hard to lower the strength of yen, but I'm not sure that negative interest rates will work really.
Alrighty, so yeah, I also have my doubts, to be honest. I mean, things have been tough there already for a while, so it's difficult to get out of that spiral, really, out of that trend in a way, right? So that's always tough. And well, let's talk a bit about the list of this last slide, I believe. What as an investor are your choices really? There's, I think, a tough situation going on. We got a lot of political developments, financial and economic, and it's just not an easy choice. I think you don't have much return going on. It's difficult shopping, I guess. So I think what you are doing by joining our webinars regularly and trying to trade the forex, commodities, and CFD markets is probably a very smart choice, because just letting the money somewhere is becoming, I think, in general, less attractive. I mean, if we compare it to maybe back in the 60s, where you bought a stock and 30 years later, you made a bundle. I'm not so sure if this is really the path forward for now. I think the situations have changed. I think everything is more reactive, more volatile. Everything is just. I don't think. I mean, I'm sure that the stock market in general will have it at one point or another climb up, and that could maybe still be one of the better bets eventually. But it's I would say a tough period for investors, and I think maybe taking trades short term and trying to learn how to trade and make capital work like that instead of long term is a good approach. What do you think, Nenad?
Yeah, definitely good approach. What I also wanted to add is definitely negative rates, but not for Japan, but for US. For example, guys, I'm not sure. This will be my final today, so keep bear with me. I will cut it short as really as I can go. So what will happen if we see negative rates in US? First, the first thing is that US citizens they will lose money. Okay, so if they try to deposit money in a bank that introduce negative interest rates, it will cause you to lose money. So why would you put money in a bank if it meant that you would have less when you take it out, right? So the first thing, well, probably that will have some impact. But now I'm talking mostly to US. Now, again, if you borrow money, well, definitely you could get paid interest for taking out a loan, assuming you can get one. Okay. Now there will still be a limit, not just for US, also for Japan, as to what banks could have, let's say, their interest rates lower to. Some people may accept minus 0.25 interest rates, but they will definitely not accept minus 2 or minus 3% before they pull their money out. Okay. Now, also negative interest rates might cause people to hold their money in cash compared to at a bank. So this will raise the risk of losing savings from theft, or let's say loss if your house burns, if you hold it, I know, outside the banking system. Also, people might start to buy short-term bonds. Okay. Yes, it will drive precious metals higher. Well, instead of putting their money in a bank, they will put cash into vaults and storage facilities. So there are really huge implications. but we are still not sure whether negative interest rates can stop deflation. Okay, because no one has any idea if that policy will work. So we don't know. Okay, we don't know that, because deflation is simply an opposite of inflation. And you know, guys, in nature, you need to have good and bad. You need to have black and white, because also in economy you need to have both inflation and deflation, because both are natural forces. But unless deflation is allowed to correct the problems in the system, it will not go away. It will just get stronger. So can we get a recourse? We still don't know, but definitely there are huge implications. Okay, people probably in US will start to move to Europe. I don't know. So I guess that US will not do that, but Japan, I'm not sure really. So that is what I wanted to make as a final touch.
Alrighty, let's see. We have a question here: will drive precious metals higher, and will money flow out like happened in China lately? Nenad?
Okay, let me see the question. This is a comment, right, Nathan? Yeah, it will drive precious metals higher. I already told you that. And yeah, money will flow out definitely, because guys, as I already explained, if you don't have money in a bank, then you obviously need a vault or somewhere, I don't know, inside your house. So, or let's say you might start to buy short-term bonds, whatever. But the thing is, money will definitely fly out. Yeah.
Alrighty, folks. Any other questions that you would like to ask just about anything, in fact, that we've discussed so far? We actually will have more webinars, of course, but also on the UK referendum. That will be 1 week before the referendum takes place. The referendum is on the 23rd of June. We're going to have a webinar on the 16th of June. So we'll discuss more of that in detail. That's coming up. But we also have we listened to your feedback through the polls of Twitter, and your preference was for price action. So we got a 2-part series on price action very soon. I think beginning of June, actually, the first two weeks of June. So that's going to be, and support of resistance next week. So we got a lot of topics to cover in the next weeks. Alrighty, no questions. So I think we can wrap it up, Nenad.
We can wrap it up. I hope that you enjoy webinar. This was a bit different webinar, but we try to give you most important things in 2016 and what can happen. So that is just our opinion. We are not sure that anything of those will happen, but the thing is that, well, we need to analyze it from time to time and give you some observations. So we wish you a great rest of the week. Don't overtrade, and be here with us, because we are here to help you. Cheers, guys, and as always, trade safe.
Cheers, everyone. Good trading.